My name is Ari Joseph, the founder of Blivus Academy. I'm dedicated to financial education and financial empowerment. I don't just teach you how to profit from the forex market, stocks market, and crypto. I also give you finances based on the provision of God upon my life. So we have an offer that you can get $100 to start trading forex. So I've been on a series on the things you have to look out for before you buy the shares of any company. And I've talked about 7 things you have to look out for. That before you buy the shares of any company, there must be 7 things. This company must meet 7 criteria. And we've done so much in-depth analysis. After we've talked, we've gone down to do practicals. We are moving further with this series. We want to research other companies in the stocks market. But before we do that, we have to outline the 7 things you have to look out for before you buy the shares of any company. So the first thing you have to look out for before you buy the shares of any company is the company's revenue. Now, the revenue of this company must be growing consistently for the past 5 years. The second thing you have to look out for before you buy the shares of any company is the company's profit. The profit of this company must be growing consistently for the past 5 years. The next thing you have to look out for before you buy the shares of any company is the company's cash flow from operating activities. On financial statements of companies, it is called operation cash flow. But I call it cash flow from operating activities. Now, this is the money that comes into a company from business activities like sales and manufacturing. So the cash flow from operating activities for the company you want to buy their shares must be growing consistently for the past 5 years. Now, the fourth thing you look out for is the company's economic moat. And I've said this before, I will say it again. Economic moat is what a company has now that is making it relevant now and will make it relevant in the future. So how do we determine the economic moat of a company you want to buy their shares? So let's say you want to buy the shares of GT Bank. First, you identify the industry of GT Bank. You identify other players in that industry. GT Banks in banking and finance. So you identify other players in the banking and finance industry. When you do that, you now look for all those players in the banking and finance industry. You look for their revenue for the past 5 years, their profit for the past 5 years, their cash flow from operating activities for the past 5 years, and the number of customers they have. Now, the company that has the greatest number or the best number is the king of that industry. So let me take that again. When you've identified other players in the industry of the company you want to buy their shares, you will now find their revenue for the past 5 years, their profit for the past 5 years, their cash flow for operating activities for the past 5 years, and their number of customers. The company that has the greatest number or the best number is the king of that particular industry. Now, I've told you that economic moat is what a company has now that is making them relevant now and will also make them relevant in the future. Yes. Now, we have discovered the company that is the king of that particular industry. We want to know whether this company will still be king in the future. How we'll do that is by researching any technological innovation that company is working on or any patent, the number of patents that they have. So if there's a technological innovation that this company is invested in or any patents that makes them outstanding, this company is still going to be the king of that industry for the next 10 to 15 years. So the next thing you will look out for before you buy the shares of any company is the company's current ratio. Yes. Now, the current ratio of a company tells investors whether the company will be able to pay their short-term debt. Now, current ratio is current assets divided by current liabilities. If the value is less than 1, it means this company you want to buy their shares will not be able to pay their short-term debt. If the value is greater than 1 or equals to 1, it means this company you want to buy their shares will be able to pay their short-term debt. So current ratio is very important for intelligent investors. Now, the next thing you have to look out for before you buy the shares of any company is the company's returns on equity. Now, returns on equity is the net income of the company divided by shareholders' equity. So if the returns on equity is less than 10%, it means this company will not be able to pay their short-term debt. For returns on equity, if the returns on equity is less than 10%, it means we should avoid this company. Because for us, our standard in Blue Academy is that if we are putting $1,000 or 1 million naira in a company, after 1 year, we want to get 100,000 added to the 1 million. That's 110 million. 1 million 100,000. Sorry, not 110 million. 1 million 100,000. See, I'm talking in millions. So you have to look out for the current ratio, whether it is less than 10%. If it's less than 10%, avoid it. If it is equal to 10% or greater than 10%, you can buy. Now, the most important thing you have to look out for here is the company's intrinsic value, the real share price. Now, why do we have to do this? The reason we have to look for the real share price of a company is because, first, a good company can be a bad investment if you buy this company shares at the wrong time. I'll take that again. A good company can be a bad investment if you're buying this company shares at the wrong time. Now, the important question intelligent investors will ask here is, what is a good company? When is the right time? So, a good company is a company that has had consistent growing revenue for the past 5 years, consistent growing profit for the past 5 years or net income, consistent growing cash flow from operating activities for the past 5 years, a strong economic moat, the returns on equity is not less than 10%, their current ratio is not less than 1. So these are the qualities of a good company. Now, immediately you identify a good company, the next thing you have to look out for is it at the right price? Is it at the right time to buy? The right time is when the company is undervalued, or when from the intrinsic value calculation, the share price is greater than what is quoted in the stocks market. So if we do our calculation for a company and we now discover that the share price is greater than what is quoted in the stocks market, it means this company is at the right time, is undervalued, we should buy. So I'm going to move over to show you practically how you can look out the revenue of a company, the profit of a company, the cash flow for operating activities for a company, the returns on equity for a company, the current ratio, and also we are going to do the intrinsic value calculation. If you're with me, let's head over. Now, the web application I'm going to use for this is investing.com. So this is, let me refresh. So this is investing.com. So you open your web browser. I already have it open. So you just open your web browser. These are the things, these are the issues. My phone is lagging. Please bear with me. I was just supposed to move over. Up. So you just type investing.com and you click go. It's going to waste time. Useless time now. Okay, it has opened. So to the right of the website is a search icon, top right. You click on it, and let's say you want to buy the shares of GT Bank Guarantee. What is GT Bank shares? Okay, let me look. Let me type GTCO. That is their name, GTCO. Please bear with me. Yeah, Guaranteed Trust Holding Company PLC. I'll click on it. So an advertisement has popped up again. I'll close the advertisement. So I just click on Guaranteed Trust Holding Company PLC. Stocks, London. Okay, it has opened. Now that it has opened, you click on financials. Okay, the financial tab has opened. Remember, I told you that the first thing you look out for before you buy the shares of any company is the company's revenue. So we'll click the revenue. This is the revenue under the financial tab. For the year 2020, it was 385,533.39 thousand. 385,533 naira as a revenue for 2020. Now, all the numbers here are in millions. Look at in millions NGN, except for per share items. So all the numbers here are in millions. So you multiply this 385,533 by 1 million. That is already 385 billion. So for 2020, we have for the revenue of GTCO, it was 385 billion. We'll move to 2021, it was 383 billion. 2022, 412 billion. 2023, 859 billion. 2024, 1.6 trillion. Their revenue. Now we'll go to net profit, net income. Let me highlight it so I can see it. 2020, it was 199 billion. 2021 was 172 billion. It dropped to 172 billion. 2022, 166 billion. It declined again. 2023, it rose to 534 billion. That's impressive. 2024 is 1.1 trillion. So they've had 3 years of consistent growing net income in the past 5 years. But their revenue grew 5 years consistently in the past 5 years. So the next thing we look out for is the cash flow from operating activities. Cash flow from operating activities. For 2020, they had a negative cash flow of 42 billion naira, 422 billion naira. So for 2020, cash flow from operating activities is the money that comes into a company from business activities like sales and manufacturing. So for that year, they had a negative cash flow of minus 422 billion naira. The next year was 1.6 billion naira. It rose to 1.6 billion naira. That is 2021. 2022, it rose to 507 billion naira. 2023, it dropped to minus 530 billion naira. 2024, it rose to 1.1 trillion naira. So they've had 3 years of consistent growing cash flow from operating activities. So I don't know the score to give them because they are no. Let's still check other things. Let's check returns on equity, current ratio, and intrinsic value before we decide. So under the financial tab, I just click ratios. So scroll down to look for returns on equity of GT Bank. So the returns on equity for GT Bank is highlighted here. It's under the management effectiveness. The value is to the right is 32.85%. That's impressive. Let's check their current ratio to know whether it's whether they can pay their short-term debt. So it is for their returns on equity. Let's go back to returns on equity. It is 32%, 32.85%. Remember, I told you that if the returns on equity is greater than 10% or equal to 10%, means it's good. So for their returns on equity, they have gotten a good point. For current ratio, let us check. Current ratio, there's no current. They don't have any current ratio. So there's no value for their current ratio from investing.com. So we can say for GT Bank, they are pretty in a scale of 1 to 10. We'll give them 5/10 or 6/10. they are somewhat a good company because they've had consistent growing revenue for the past 5 years, consistent growing profit for the past 3 years in 5 year period, consistent growing cash flow for operating activities in 3 years period in the past 5 years. So, and this is 2025. We don't know how the year will look like. So, we are giving them a score of 5.5 over 10. So, we want to check. So, we are saying they are pretty. It's a pretty fairly good company. So, we want to check whether at $0.06, because yes, the currency is in US dollars, $0.06, whether GTCO is the right price. So we'll go to our calculator. What just happened here? Let's go to our calculator. This is our intrinsic value calculator. I just did the calculation for Presco. You can check the video out. So let's put GTCO. That's the name of the company. The next information we have to input in our calculator is the free cash flow of GTCO for the year 2024. Where is our website? What is playing here? So let me click on financials. I'll click on financials. Check. Okay. We are looking for the free cash flow of GTCO. Oh, they don't even have a free cash flow. So because of this issue, we cannot even do the calculation. The free cash flow is not quoted here. So because of this, we cannot even calculate whether the 0.06 naira, $0.06 is the real share price of GTCO, because they don't even have a free cash flow. They've not given us current ratio. So we can just, for GTCO, their information is pending. I think that will be all for GTCO. Take charge.